Hello friend, welcome to my channel. Today we are going to discuss about ratios, types of ratios, mostly focusing on liquidity ratio. So today we are going to discuss about what liquidity ratio means and what are the types of liquidity ratios, full clear concept with definitions, formulas and example. Now let's get to the point. Let's start. Liquidity ratio. Liquidity ratio is also known as short-term solvency ratio. Liquidity ratio is also known as short-term solvency ratio. Liquidity ratios are a type of financial ratios used to measure a company's ability to meet its short-term obligations using its current assets. This ratio indicates whether a company has enough liquid assets to pay its bills and debts as they come due. So, what does liquidity ratio means? It's the financial ratio which is used to measure a company's ability, company's willpower to meet its short-term debt, to meet its short-term debts or liability or obligations using its current assets. By using its current assets, this ratio indicates whether a company has enough liquid assets to pay its bills and debts. Now we are going to discuss about types of liquidity ratios. There are mainly 3 or 4 types. One, current ratio, quick ratio, super quick ratio and defense interval ratio. So we are going to discuss about 4 ratios. Now let's start from the current ratio. Current ratio is also known as working capital ratio. Current ratio is also known as working capital ratio. The current ratio, CR, the current ratio is a financial ratio that measures a company's ability to pay its short-term obligations, such as bills or debts that are due within 1 year using its current asset. So, what does current ratio means? Current ratio is a financial ratio that measures a company's ability to pay its short-term obligations or debts or bill that are due within 1 year using its current assets. It shows whether a company has enough assets that can be quickly turned into cash to pay its bills or debt or liability that are due in the near future, usually within 1 year. It shows whether a company has enough assets that can be easily turned into cash, that can be easily converted into cash to pay its bills, debt that are due in the near futures or usually within 1 year. It's very simple. Now we are going to take one of the example. For example, if a company has a current ratio of 2:1, it means that the company has rupees 2 worth of current asset such as cash, inventory, account receivables for every 1 rupee of current liability. To pay 1 rupee of current liability, company has rupees 2 worth of current assets. This indicates that the company has enough assets to cover its liabilities and is in a good financial position to meet its short-term obligations. This means it has enough liquid resources to cover its short-term obligations. It is very easy. It's simple word. Okay. Now On the other hand, a current ratio below 1 is to 1. We had taken an example of 2 is to 1. Now, if a company or current ratio has below 1 is to 1 current ratio, then what does it indicate? It may indicate that the company is facing liquidity issue and may have difficulty in paying its short-term debts. It means that the company has more short-term liabilities, means more debts, more bills, more liability than short-term assets, which may indicate that the company may have difficulty in paying its bills on time. Now we are going to discuss about its formula of current assets. Current ratio. Current asset upon current liability. The standard ratio is 2 is to 1. Now, what does current asset means and what does current liability means? Current assets are that assets that can be easily converted into cash. Current assets are those assets which can be easily converted into cash within a year, such as cash, account receivable, inventory. Likewise, what is current liability? Current liability are obligations that a company needs to pay within a year, such as account payable, short-term loans, tax due, etc. Now, we are going to discuss about current assets and current liability. What does it includes? What includes on current assets? Current asset includes cash, bank balance, cash and bank balance, debtor balance. But one of the important point, debtor balance should be adjusted after deducting provision of doubtful debts and provision for discount on debtors. From the debtor balance, we have to deduct provision of doubtful debts and provision for discount on debtors. Similarly, bills receivables. Likewise, after deducting provision of doubtful debts and provision for discount on debtors, bills receivable. Marketable securities, we have to adjust in realizable value, stock of raw material, WIP and finished goods. Prepaid expense. What does prepaid expense indicates? Expense that a company has paid in advance, such as insurance premium or rent payments. Prepaid expense, this is important. It will be further coming in quick ratio also. Okay, so you have to think about that. Prepaid expense. What is prepaid expense? Expense that a company has paid in advance. The company has paid in advance, such as insurance premium or rent payments, etc. Likewise, short-term loans and advance. And lastly, accrued income. What does accrued income means? Accrued income. This is income that a company has earned. Accrued income means income that a company has earned but has not yet received in cash is accrued income, but has not received in cash. And advance payment of tax. Advance payment of tax is also current asset. Now, what does current liability includes? Current liability includes creditors of goods purchased, bills payable or account payable. What does bills payable or account payable means? Goods or services received. Company has received a goods or services, but the company has not paid yet in the cash, but not yet paid is bills payable or account payable. Short-term loans and borrowings. Accrued expense is also mainly known as outstanding expense or accrued expense. What does it means? These are expense that a company has incurred, expense that a company has incurred but has not yet paid, such as salaries, interest, rent is outstanding expense or accrued expense. Likewise, bank overdraft income tax payable. This includes any tax that a company owns to tax authorities but has not yet paid. Dividend payable. This refers to any dividend that a company has declared but has not yet paid to its shareholder is dividend payables. Advance payment from customer. Advance payment from customer. These are the payments that a company has received from customer in advance of delivering goods or services. And lastly, interest payable. I think you have understood about the current ratio, its formula, its implication, what includes in current asset, what includes in current liabilities. Most important, you have to know it. Now we are going to discuss about quick ratio. What does quick ratio means? Quick ratio is also mainly known as liquid or acid test ratio. Quick ratio is a liquidity ratio that measures a company's ability to meet its short-term obligations using its most liquid asset. What is most liquid assets? We are going to discuss further. What does quick ratio means? It is the liquidity ratio where inside the liquidity ratios. Yeah, so quick ratio is a liquidity ratio that measures a company's ability to meet its short-term obligations, short-term liabilities using its most liquid asset. In other words, quick ratio are those assets which can be converted into cash within a quick period of time. It can be calculated by deducting inventories and prepaid expense from the current asset. Oh, what does it means? It can be calculated by deducting inventory and prepaid expense from the current asset. Why you are deducting inventory and prepaid expense from the current assets? We are going to discuss. By excluding prepaid expense and inventory from current assets, the quick ratio provides a more accurate picture of a company's ability to pay its short-term debt using its most liquid asset. Okay, by excluding prepaid expense and inventory from current asset, the quick ratio provides a more accurate picture of a company's ability to pay its short-term debt or liability or obligations using its most liquid assets. Here is one question: why we deduct inventory and prepaid expense? While calculating quick ratio, inventory are deducted from current assets because it may not be realized in cash within a quick period of time. What does realized in cash means? Here is note. Realized in cash means that an asset has been converted into cash and the cash has been received by the company. It means the company has sold or disposed asset and has received cash in exchange. This means if we have an inventory in our company, then it does not realize in cash in the quick period of time. So we have to deduct inventory from current asset, and prepaid expense is deducted because it has already been paid to third parties and will not be possible to convert in cash to meet current liability. We have already discussed about prepaid expense. What does prepaid expense means? Prepaid expense means expense that a company has paid in advance, such as insurance premium or rent payments. Likewise, we have paid prepaid expense, we have paid in cash in advance to other parties, to third parties, and this cash will not be converted in cash to meet a current liability. This cash will not be returned back, so that we are deducting the prepaid expense from current asset. Now we are going to discuss about formula. What is formula of quick ratio? Quick ratio means, I think you know all, current asset minus inventory minus prepaid expense divided by current liabilities. Why we deduct inventory and prepaid expense we have discussed already. The standard ratio is 1:1 for quick ratio. What does it indicate? The higher quick ratio indicates that a company has larger amount of liquid asset available to pay its short-term liabilities or obligations. This was the quick ratio. Now we are going to discuss about super quick ratio. Super quick ratio or cash or absolute cash ratio. Cash ratio is a liquidity ratio that measures a company's ability to pay off its current liability using only its cash and cash equivalents. What does cash and cash equivalents means? Cash and cash equivalents means or includes cash, bank balance and marketable securities. A higher absolute or cash ratio indicates that a company has larger amount of cash and cash equivalents available to pay its short-term debts. Then here is the formula for cash ratio. Cash ratio means cash plus bank plus marketable securities divided by current liabilities. Arita, I forgot to write the formula, so we are discussing now. It's very simple. A higher absolute cash ratio indicates a company has larger amount of cash and cash equivalents to pay its short-term liability, means current liability. Now we are going to discuss interval measures and defense interval ratio. Firstly, interval measures or defense interval ratio formula: cash plus bank plus marketable security divided by daily cash expense. What does daily cash expense means? Daily cash expense can be calculated by annual cash expense minus non-cash expense divided by 360 days. What is non-cash expense? Non-cash expense means depreciation, amortization, if any. No. Now interval measures formula: cash plus bank plus marketable security divided by daily cash expense. Daily cash expense means annual cash expense minus non-cash items or expense divided by 360 days. The resulting numbers, the answer will be comes in days. The resulting number represents the number of the days that the company could continue to operate the business without generating any revenue or accessing external source of fund. We are going to discuss with example later on. The higher the defense interval ratio, the more days the company can continue to operate without generating revenue. The low defensive interval ratio may indicates that the company is more vulnerable, that means at risk to cash flow fluctuation and may have difficulty in meeting its operating expense. Let us take example. If a company has a defense interval ratio of 80 days, which indicates that it can continue to operate for 80 days without generating any revenue or accessing external source of fund. Very simple. That was the 4 ratios which is important to. Now lastly and conclusion, liquidity is a critical aspect of a company's financial health as it determines whether a company can continue to operate smoothly and avoid defaulting on its debts. A company that is highly liquid has ability to quickly and easily convert its assets in cash to pay off its obligations. While a company with a poor liquidity may have difficulty in meeting its obligation and could be at risk of bankruptcy or financial problem. I think you have understood about all the liquidity ratio. Please note down, it's very important. Thank you so much. Have a good day. Best wishes.